This was 2008, the year over 6 million American households lost their homes to foreclosure, all while Micheal Burry, the hedge fund shark, made billions.
Made a ton of money, much more than I ever imagined, I'd ever have.
But who is Micheal Burry? He's a value investor and a hedge fund manager in addition to being a doctor in the United States. During the great financial crisis of 2008, Burry founded Zion Capital LLC, a fund that made billions of dollars in gains for its customers when the American housing market collapsed. While pursuing his medical degree, Burry developed a passion for stock investing. In his free time, he looked into value investing ideas even though he had a degree in economics.
The world of investing.
By 2000, Burry had made up his mind that a career in finance piqued his interest more than medicine did, and left Stanford without finishing his degree. As a result, he went on to form Zion Capital, where he had great success as an investor and quickly made a name for himself on Wall Street.
Man, business is war.
Investor Burry was the select few who had gambled against the mortgage industry before its collapse in 2008.
How much money you made?
$70,000 last month.
He clearly earned a fortune doing so, and yet despite his stature as a historically significant transaction, the emotional interaction between Burry and his customers makes his narrative so compelling to us. Burry got worried in 2003 when he saw an increase in the number of subprime mortgages being given. As a direct consequence, these loans were packaged together with other loans and sold to investors as mortgage-backed securities. Burry could see a gap in the wobbly framework that was taking form. By 2005, Burry had reached the point where he was so sure that the housing market would crash that he developed a financial derivative instrument known as a credit default swap to short the market. This derivative instrument is a weapon of mass deception against the housing market. If you get insurance, you will be required to pay a premium. If the value of real estate dropped, he was shielded from the obligation of making a payment thanks to this protection. The first few months were challenging for Zion due to these surcharges, which cut into the company's profitability and angered investors. However, Burry's forecasts did not start coming true until 2005. Before that year, they remained unfulfilled primarily. As a result of Burry's bet against the housing boom, he raked in $100 million for himself, while his investors collected a cool $700 million. Though in 2008, for unknown reasons, Burry brought Zion Capital to a close. Later that year, he reopened under the name Zion Asset Management, and since then, he has made several investments in the real world. The origins of the 2007 and 2008 financial crises were intertwined for years. In the early part of the decade, low interest rates and weak lending requirements sowed the seeds of the housing bubble, resulting in an upward property price spiral. Many of these loans were subprime, meaning that the borrowers could not pay them, placing the loans in danger of default. Mortgage-backed securities and collateralized debt obligations were then sold by lenders to Wall Street investment banks. The regulations that had been repealed allowed banks and other institutions to take on large amounts of debt to purchase these assets, which they subsequently repackaged and resold to other investors. Regarding hedge fund managers, Micheal Burry is one of the best.
Lewis writes, Micheal Burry was doing the first real analysis of the creditworthiness of the subprime borrowers and the structure of the complicated Wall Street mortgage securities, the kind of work that was supposed to have been done by bond rating agencies like Standard & Poor's and Moody's so that investors could accurately judge their risk.
When Burry thinks that the thriving US housing market is nothing more than an asset bubble created by risky loans in 2005, things get interesting. Using a few financial instruments known as credit default swaps, Burry may short the housing market, meaning that he could sell holdings believing that values would later on fall. During this time, customers of Burry's are becoming more enraged and afraid as Burry continues to perform his short plays, even though banks and creditors are claiming that the housing market is steady. When his customers were seeking their money back, he restricts the ability to withdraw funds, which further enrages those customers. Burry's business, Zion Capital, which he founded, emphasized investing in deep value. As a result, they aimed to acquire low-priced long-term assets, and when they became overpriced, sell them for a nice profit. Going long value stocks was where Zion Capital made the most money from 2000 to 2005. Interestingly enough, customers could grasp the notion of purchasing supplies at a discount, which had paid off. Shorting mortgage bonds became an attractive investment for Burry in 2005. When an investor's investing philosophy undergoes a significant shift, it's simple to see why they would feel uneasy. That is precisely what happened. Burry chose to short a particular area of the mortgage industry after 5 years of purchasing inexpensive equities. Furthermore, he favored a cutting-edge derivative known as credit default swaps as his primary tool. But just because there's a reason to be upset doesn't mean that being upset is justified. Investors are known to react negatively to even the slightest periods of underperformance. Both in academic circles and through personal experience, I've noticed this. Investors tend to have a short memory and unwillingness to give well-reasoned investing ideas that require length of time to show their worth. Regardless of the bias, anchoring prospects theory, or the determined consequences of herding, considering that Burry's CDS holdings were geared toward profiting during the negative part of the market cycle, he requested 3 to 5 years for his theory to produce fruit. In fact, Burry's life was so stressful between 2005 and 2008 that he required medical treatment for ulcers that were bleeding. This may not seem like a big deal right now, but think about where you were at the end of 2008 and the beginning of 2009, when your mental state was probably hurting your stomach. Those were dark and awful days. Burry was disciplined for being short too early, while others were penalized for being too long too late. No one likes to lose, particularly with the stigma of being an outcast for trying something new. But that's a weight we have to be happy to bear, to be on the right side of history sometimes. As a consequence, millions of people lost their jobs and houses due to this investing and trading in the financial market. This can teach us valuable lessons for our personal lives. The collapse of the housing market and credit bubble was not caused by a single event, but rather a series of events. More and more banks in the United States are lending out money to people who can't afford to repay their loans. Bankers sold unaffordable mortgages at unreasonable rates of commission. Burry's plays required guts to take the risks that he did throughout his career as an investor, and we could say that paid off handsomely. He actually walked out with a load of cash. He was one of the most successful investors in history because he trusted his instincts and stayed true to them. Wall Street corporations like Lehman Brothers were also seen to be greedy and deceitful in the crisis. Because they didn't completely comprehend the dangers of lending money to those who couldn't repay them, they opted to forego routine risk checks. Unexpectedly, his financiers could not cooperate with him again since the relationship had gone so sour. Burry could not get money for his fund again, and therefore he decided to liquidate the assets. And despite his enormous riches, Micheal J. Burry's lack of social skills and strained relationships with investors led to the end of his career as a public fund manager.